Vikas Khemani joins us now. Let's take our conversation forward. Vikas, it's one of those moments in the market where you can celebrate mentally by looking at the screen. You can feel happy that portfolios have gone higher, but nobody's feeling happy or excited. There is very little participation, no euphoria, and a lot of disbelief.
Absolutely, Nikunj. That has been the characteristics of the market for last many months. Especially everybody was overly worried about U.S. recession and impact of that on India, and a lot of people are sitting on cash. Pessimism has been high, and always the case. Bull markets or good moves are built on the wall of worry or wall of skepticism, and that is what we are seeing right now happening. And that's what exactly we had written in our last month's letter or last few months. Every letter we've been writing that pessimism is high, worries are unfounded, and I think we have seen markets slowly climbing up bit by bit, to everybody's surprise, in last few months.
Because I'm wondering whether time has come now to start at least nibbling into IT and whether a large part of the pain is already in the price or not.
See, look, again, I think in general we are quite bullish on the market, and IT, of course, has been a sector which did very, badly in the recent past, backed by the worries of the U.S. recession and slowdown. And I think, which is what now market seems to be getting comfort around with the U.S. market stabilizing. Our view has been very clear that inflation has peaked out in U.S. Interest rates have kind of peaked out, especially from expectation perspective. You might have another 75 basis point, 100 basis point can come through, which is already baked in the market. With a high inflation, and commodity prices, food prices, and oil prices coming down, it is very mathematical thing that inflation will come down. Whether it can be 2 months, 3 months, 4 months, it's just a mathematical equation. So that will have to give comfort to Fed, that which got surprised post Ukraine war, and they had to kind of act in a knee-jerk way. So that clearly shows that as the interest rate peaks out, Fed starts becoming comfortable. U.S. markets, which is again there also pessimism is very high. So I guess that liquidity flow will come through and markets will stabilize. So once the sentiments around overall U.S. economy settles down, I'm sure IT will also do well, because IT per se did not have any problem. Demand was always good. Even last 2 quarters, all companies have had good order wins. Attrition problem is settling down, and this quarter we see even getting better. So, and risk reward of the sector is fairly in favor. They are not outrageously expensive. So we continue to believe that IT is a sector which will do well.
Vikas, and we've seen strength in rupee. FIs are back. The minute the local currency of any emerging market stabilizes, foreigners, they make a comeback. Rupee is now heading towards 81. 2022 has not been a great year for flows. Now that inflation is peaking out, rupee is stable, are we in for massive inflows coming back by global investors into FY23? And if that happens, what happens to the profile of stocks, nature of stocks which will outperform and underperform because of the liquidity factor?
Absolutely, Nikunj, and this is precisely what we wrote in our last letter also, that three peaks have been made. Interest rate, inflation, and US dollar. And if you look at historically 40, 50 years, in a cycle, whenever Fed starts raising interest rates, the typical rule book is that, emerging market imports inflation, their economies slow down, and hence they generate negative returns. So most developed market investors start pulling out money from emerging markets the moment Fed starts talking about raising rates. And which is what precisely happened in last 12 to 15 month cycle when Fed raised rates aggressively. We saw massive outflow of $40 billion or plus or minus thereabouts. Now, as that rate peaks out, and you can go back and look at any cycle, as that rate peaks out and starts coming down, you start seeing massive flow coming towards emerging market. So I see, calendar 23, a massive flow year. It could be 15 billion, 20 billion, or maybe 25 billion. That is anybody's guess. But I see, India is progressing very well. There's no alternative economy or market which can offer the same kind of profile, and everybody is underweight, India. So if you just say, I just see a very massive liquidity profile coming towards India in next 12 to 18 months.
Okay, so you're expecting a big inflow to come in the next 12 to 18 months. And as that happens, Vikas Khemani, our viewers will also then want to know, right, Where will all that money go and how can they also make money? So let's keep discussing that. We got your views as far as IT goes. That's traditional IT. What about new IT, the new age tech companies? There's a case that are they too oversold? Is there money to be made? You have GIC, which is now doing, a deal as far as Zomato goes. You start to see a comeback of sorts a little bit in Policy Bazaar. Nika's picking up steam. What's your take when it comes to these stocks?
I think there are some interesting plays which can be looked at it, but again, it's not about new IT. I mean, in general, you can't, still say that everybody looks good. Again, it boils down to looking at the company business model, understanding and whether they can kind of survive and do well over a long time. According to me, while some players are looking attractive, but still it is not where it should be. More importantly, I mean, we like companies like Zomato in the recent past, but we see a lot of selling flow coming through in that, and also there are some headwinds in terms of the new disruption happening in form of ONDC. What will be the impact of that? So I think one has to be very, very careful in looking at the. It is never about new IT versus old IT. It is about whether risk reward is there. You understand the business model. Is there a business model which has a differentiation, continued growth? All those things. As long as we understand, I think it's good. But still, we haven't found any solid, convincing idea where we can put our money behind.
Okay. The other thing I wanted to talk to you about was, and I was going through your portfolio, and if I were to see the top 10 holdings, what is conspicuous by absence, and that has been your play in the past too, the lack of PSUs. A lot of people are now saying that there is a case for re-rating of PSUs. Look what's happened with the mid-tier banks, the defense stocks, the railway stocks. You're going to continue ignoring this, or you just don't want to be too hedged for it? What's your strategy?
No, we do own Bank of Baroda in our portfolio. So it's not, while I think in general we've been more in favor of private companies, no doubt about it, but we have not ignored when the opportunity has been presented, there's a re-rating happening, business cycle is in the favor. Some of the large banks, especially in the PSU, have been repairing themselves. So we found the risk reward in favor of Bank of Baroda. So we have taken that, but we keep looking at opportunists. We also own in another portfolio HAL, which again is a very promising idea. So it's not about, we never dislike permanently and we never like permanently. It's just that you have to look at risk reward of individual stock. What is the broader tailwind in a particular favor of a sector? So investing, you should never say no to anything. One has to constantly keep on looking at it, and we have taken these two PSU names. So don't misunderstand it that we don't buy PSU. As long as we understand and we see that things are in the right place in favor. Of course, PSUs by nature have a little bit of a compromised management style because of the non-continuity of the management team. That one has to be very, very clear and factor in your investment thesis.
All right, Vikas. I'm going to ask you one question. You bought into Aditya Birla Financials. Don't go away. Don't smile. I have a question which just came to my mind. You bought into Aditya Birla Financials, pretty much like you bought into ICICI Bank when there was change of guard. Stock is up, 40 rupees ever since you bought it. Happy to hold it, or time to now reassess and that one-time adjustment is over?
No. So we never buy stocks on such large holding in our portfolio based on some one-time adjustments. This is a very carefully bought story where I think again very classic. What we have, as you have seen us, what we call magic stories, where we can get both earnings growth and valuation re-rating, and we have a whole framework around that. And Aditya Birla Capital, it was a good franchise. The borrowing profile is as good as Bajaj Finance, but I think it kind of languished for many reasons, especially the management reasons. So we saw recently change in the CEO where Vishakha Mulai, who was one down of Sandeep Bakshi from ICICI Bank, went to Aditya Birla Capital, and I think she is leading a transformative journey out there. So we were very convinced about what she's trying to do, and platform is good. So I mean, what else you want? You have a good platform and a right driver, right CEO, which is guiding and organizing a new direction, and that is a short or very good high probability recipe for re-rating of any stock, and that's what is in way. So what we have seen, probably in my opinion, is just a very early sign of correction. It's not I mean, we don't buy stocks only for 40-50% return. I mean, we think that it's a multi-year journey, and she is an exceptionally good leader. As she delivers, markets will take note, and it will get re-rated further.
Appreciate your time. Thank you for joining us, and no more follow-up questions. So you can actually log out.
Thank you very much, Nikunj. Lovely chatting with you.